Hi everybody, this is Lara with your end of the week video for gold for the trading week ending Friday 23rd of August 2019. There's been a classic upward breakout from a small pennant pattern on Friday, a close above the upper trend line of the pennant pattern with support from volume for the day. The target using the flagpole from the pennant is at 1660. I've got a new bearish Elliott Wave count, well slightly new. It expects that the first target for upward movement to end is at 1543. If price keeps rising through that target, then the next target for the bearish count is 1572. The much more bullish count expects that the consolidation should continue for another couple of weeks or so. They start to diverge now a little bit, the bullish and bearish Elliott Wave counts, and I've got a new bearish wave count for silver, which pretty much follows on from this pattern for gold. This is still the preferred wave count for gold. It still expects that upward movement is going to end at some stage soon, and we're going to see a major trend change and a new wave down to new lows below 1041. I think this was back here. It expects the upward trend, which is now very extreme and stretched, is going to come to an end maybe in another couple of weeks or so. This structure sees supercycle wave B as a double zigzag. They're fairly common structures, but within double zigzags, their X waves are almost always single zigzags. X waves can be any corrective structure though, and in this instance it looks like it was a regular contracting triangle over down here. The first zigzag in the double is labelled cycle wave W. It subdivides 535. The double is joined by a corrective structure in the opposite direction labelled X, which subdivides as a triangle. And then the second zigzag in the double begins here. It's subdividing 535, and we're now looking at the final fifth wave. Supercycle wave B may not move beyond the start of supercycle wave A, which begins at gold's all-time high at this price point. If we do see a trend change, I'm then going to use very specific confidence points to show which wave count is more likely. If we see a new low below this price point, that's the high of intermediate wave 1, that means that downward movement within primary C could not be a continuation of intermediate 4, which means intermediate 4 and 5 would probably have to be over. The next confidence point at 1401.3 is the start of primary wave C. A new low below that point could not be a second wave correction within primary C, and so at that stage we would have price confirmation that if I've got the beginning of it right, primary C should be over. And finally, a new low below the final full confidence point would invalidate the bullish wave count and provide quite a lot of confidence in a bearish wave count. So that's what those three price points mean. Let's take a look now at the daily chart for this wave count. We're going to look at this high here for primary D within cycle X, this point here, this point here. I'm going to show the same piece of movement for all of my daily charts. Here's the end of that triangle for cycle X and the start of the last zigzag or the second zigzag in the double for cycle wave Y, subdividing 535. I know B wave, this B wave triangle is actually 5 subways, and kind of term it an Elliott wave 3, and that it's a corrective structure. This wave count sees the triangle in a B wave position. This has a really good look. And if this is where B ends, then this is where C begins. And primary wave C must subdivide as a 5-wave motive structure. There are only 2 Elliott wave structures possible here, an ending diagonal or an impulse. And an impulse is so far pretty obviously what it's unfolding as, and they are much more common. So far it's subdivided 1, deep zigzag for 2, 3, which has a really close 1.618 Fibonacci ratio to 1. 4 now looks likely to be complete as a relatively shallow zigzag, so there's alternation between the depth of 4 and 2, even though there isn't alternation between structure. That's okay. Alternation is a guideline, not a rule. It's most often seen, but not always, and there is some alternation here. Zigzags also are the most common corrective structure. If 4 were to continue further, it may not move into wave 1 price territory, but I am going to now label it over here for a couple of reasons. The strength of upward movement, the breakout above the pennant pattern, we'll see that when we get to classic technical analysis, and the proportion here between intermediate waves 2 and 4 looks really good. Intermediate wave 2 I think lasted 9 sessions, and intermediate 4 7, so there's pretty good proportion, and intermediate 4 is more brief than 2, as fourth waves for gold's impulses almost always are. I have 2 targets now for intermediate wave 5. Now I know where it begins. I can apply Fibonacci ratios at intermediate degree to calculate a new target, so I've done that. For intermediate 5 to reach the most common Fibonacci ratio, that of equality in length, with intermediate wave 1 at this first target. If price gets up to the first target and the structure of intermediate 5 is incomplete, or if price gets up there and just keeps on rising, then for this count I'll use the next target. For primary C to reach the most common Fibonacci ratio for a C wave, that of equality in length with primary A at the second target. Use this best fit channel. I've drawn it from this low to this low and placed a parallel copy on this high. Look out also possibly for upward movement to find resistance about the upper edge of that channel. And so I'm expecting probably another couple of weeks, maybe 1 week, maybe another 2 or 3 weeks of upward movement to one of these targets for this wave count. This is still the preferred Elliott wave count. At the hourly chart level, here's a look at the zigzag for intermediate 4, subdividing 5, 3, 5 with a nice regular barrier triangle for minor wave B and a short little wave for C down. I'm labelling this so far within intermediate 5, minor 1, 2, 3, 4 and 5 to unfold. This would fit with the first target, but for the second target I may need to move the degree of labelling within intermediate 5 down 1 degree. It may be longer lasting. For the short term, when markets open next week, minor wave 4 may not move into minor wave 1 price territory below the short term invalidation point. At the weekly chart level, this is the bullish alternate wave count. This wave count sees the end of the bear market back down here and the start of a new bull market for gold. For those of you who have been members for a while or been watching these videos on gold for a while, you may want to skip through the next bit. I'm just going to explain why this wave count is an alternate. In terms of Elliott wave, there is a very substantial problem here. Gold is a commodity, and commodities will typically exhibit swift, strong fifth waves, and that tendency is especially prevalent for fifth waves to end its third wave impulses 1 degree higher. Here's an example here, and here's an example here. Within the fifth wave of minor 3 here, and the fifth wave within minor 3 here, there is swift, sharp movement down to here. When that happens, it forces the fourth wave that comes just prior, which is in here, and just after, which you see here, and this one here, to be more brief and shallow than it would otherwise be, giving gold's impulses a 3-wave look to them, or a curved look, and it works in a bull market the other way round as well. And so here minor 4 is brief and shallow, whereas minor 2 is much more time consuming and deep. Brief and shallow, time consuming and deep. Now that's a really common, typical look for an impulse for gold to have. But what is extremely unusual, not unprecedented, I have seen it happen, although not quite to this degree, is the situation we have here. If you are going to see any Elliott wave count which sees gold in a bull market, then you have to resolve the problem, or you have to acknowledge that there is a problem, that from this low to this high, this movement does not fit as a typical 5-wave impulse for gold. It's very obviously not a diagonal, it's possibly an impulse, although to be honest it fits better as a zigzag. The problem with the impulse is the fourth wave covers a much greater distance in terms of price and time than its counterpart second wave does. This is just 2 weeks in duration. This is, I think, 12 weeks in duration and covers a much greater distance. This part of the wave count looks extremely unusual for this market. This part of the wave count looks wrong. There's no other place to see the end of the first 5 wave structure up off the major low if you're trying to see a bullish wave count for gold. After that, this wave count has no problems though. Cycle wave 2 here fits as a double combination, zigzag X flat correction, mostly a sideways movement, no problems there. Cycle 3 may have begun there. The target is for it to reach a common Fibonacci ratio to cycle 1. It may only subdivide as an impulse, and so far there may be primary waves 1, 2, 3 and 4 still to continue. For this count, I could try and label primary 4 over here, and it is pushing it, but it would fit and be somewhat acceptable for this wave count. But in order for it to have better proportion to its counterpart primary 2, I would expect it to continue for at least another 2, possibly 3 more weeks. It may not be deep enough to come down to the lower edge of the Elliott channel. It may not move into primary wave 1 price territory. I will accept for this bullish wave count no movement at all below the invalidation point, because this is using cash market data, or the closest approximation of it that bar chart can give me from various bank feeds. And so because this is cash market data, not futures data, I will accept no overlap between the 4th and 2nd wave for this wave count to remain valid. Let's take a look at the daily chart now. We were going to see from the end of primary 1, this high here. Here we have 1, 2, 3, 4, possibly to continue at least for another couple of days, if not another 1 or 2 weeks, to have somewhat reasonable proportion to 2. But if price just continues on upward, as I expect it's likely to do early next week, then I will label primary 4 as possibly complete back down here, even though it would be extremely brief in comparison to primary wave 2. That's okay. 4th waves for this market, particularly 4th waves within 3rd wave impulses 1 degree higher, can be remarkably brief compared to their 2nd waves. But let's expect a slightly better look and another couple of days, if not a week or so, of more downward movement to complete primary 4, probably as a flat correction. The target for primary 5 remains the same. At the hourly chart level, primary 4 could still be unfolding as a double zigzag, double combination, flat correction, or possibly a triangle. If primary wave 4 is continuing as a flat correction, then it would subdivide 3, 3, 5 to be labelled intermediate A, B, C. It would be a regular flat because intermediate B has passed the minimum required 90% the length of A, but it's less than 1.05 the length of A, so that indicates a regular flat. The target for that would be for intermediate C to reach equality in length with intermediate A. Primary 4 could also be a double combination with a zigzag for the first structure in the double to be labelled intermediate W. The double could be joined by a 3 in the opposite direction, a zigzag labelled intermediate X, and a second structure, either a flat or a triangle for intermediate Y, may now begin to move price sideways. Primary 4 could also be a double zigzag, but double zigzags don't usually have really deep X waves, and this one would be very deep, so I think that's a least likely possibility now for primary 4 if it's going to continue further. Primary 4 could also be a triangle, so far with A and B complete, now requiring C, D, E. Sideways movement in an ever-decreasing range for another week or 2 possibly. Or, if we see continuing upward movement next week and we see support from volume, any bullish signs from on-balance volume or any other indicators, I'll then move the degree of labelling within this zigzag up 1 degree, and I'll label primary 4 over as a remarkably brief and shallow zigzag. That's entirely possible for this market. Okay, let's have a look at some classic analysis, and I've zoomed out for the weekly chart to show you these previous strong areas of resistance which were broken some weeks ago. A really shallow, quick little back test, that's all we got. And now, which was previously resistance last week at 1525, has been broken on Friday with a close above that point. Although at the weekly chart level, volume is not supporting this upward movement within this week, Friday's strong upward day does have support from volume. Much of this week was taken up by consolidation, hence the lighter volume. Just because this volume this week is lighter doesn't give a great cause for concern. Volume doesn't have to completely move strongly higher every week. Overall, we do still have an upward trend from volume supporting the rise in price. There was a weak bullish signal last week from on-balance volume as it broke above resistance. The signal is weak because the resistance line breached has quite a strong slope. ADX is now indicating an upward trend which is extreme. As price is rising, ATR is increasing, there is strength in the upward trend. RSI remains quite strongly overbought and ADX indicates the trend is extreme, but these two can remain extreme for several weeks and price can move a considerable distance when this market has a strong trend. With both of these indicators showing that this trend is extreme and overbought, extreme caution regarding careful risk management is strongly advised. We have no evidence the trend is over, but we have to understand it could end at any time. Stochastics also overbought, MACD full bore bullish. At the daily chart level, here's a small pennant pattern, the best performing pennants and flags, complete within 15 sessions. This one lasted just 7 sessions. Friday has effected an upward breakout with a close above the upper trend line of the pennant on an upward day which has good strong support from volume. This is a classic upward breakout. The target at 1660 is taken from the breakout point, and I've added the flagpole length from this high to this low to that price point to calculate a classic target from that pennant pattern. On balance volume is at resistance. If it breaks above resistance on Monday or Tuesday, that would be a bullish signal. The resistance isn't very strong, but it's not too weak either. This may assist to halt the rise in price. We could get a little back test of support before price moves up and away. RSI back again into overbought territory. At the last high, there was double bearish divergence that could now be resolved. Sometimes divergence just disappears, but so far with the data in hand, we did have divergence here. We were expecting some consolidation or pullback to resolve that. It may now be resolved. ADX at the daily chart level now indicates that the trend is very extreme. The ADX line is above both directional lines and above 45. That indicates a very extreme trend. So caution is advised. The trend could end at any time. By end, I mean be interrupted by a really big consolidation, or we could have a full change from up to down. There are three directions for price: up, down, or sideways. ATR was declining as price was moving sideways. It may now again show an increase as price moves higher. Stochastics back into neutral territory, and MACD gave us a bearish crossover last week. That's all from me this week with your gold analysis. I hope all our members are having an awesome weekend.